Guys, good afternoon, good evening. Hope you guys had a fantastic weekend. Don here going over the strategy, my strategy, my little hybrid strategy that I use now. Let's get to it, right? Hope you guys had a great weekend and hope you guys are ready to kill it this week. So I'll try to keep this video short and simple. I'll show you what I do, what indicators I use, how I'm trading around the strategy that I'm using now. And yeah, that's about it. Looking at the SPY 9/15/22, which was Thursday. For the most part, I am a primarily SPY trader. That's usually my bread and butter. So I'll teach you my strategy on something familiar, but the strategy could apply to any stock. So let's get started. So for starters, first thing I'm doing is I'm doing my little pre-market ritual where I got my coffee, ate my breakfast. What I'm doing is I'm looking at the previous day, what happened in that session, right? So I want to mark some remarkable things. The previous day's high, we want to have that mapped out, right? We want to look at the previous day's low. These are going to be significant levels for the upcoming session. And another thing I do is anytime the stock had a insane move off of some level, I'm going to highlight that as well because there's going to be some strong reaction usually on the next day, right? So in this case for SPY on the 14th, pulls down here to this level, wicks under it a little bit, and then rips to new high day. So this level is a significant level. We're going to draw that there as well. So that's going to be step one. We're going to look at what levels held up. You can also draw a few levels, at places like this that hold if you want to do that, but I don't want to clutter the chart too much, and I'll kind of show you guys something else like that I do. So just a little backstory. For the last few months, I was using the Strat, right? The Strat's the strategy that has 1, 2, and 3 candles, 1 being inside bars, 2 being directional movement bars, and 3 being outside bars. I found that for me, it just wasn't clicking. It made sense, but certain aspects of it didn't make sense. So I took the best things I liked from the Strat, applied it to my old strategy that I was using, and kind of made a new little Frankenstein kind of thing. So one thing that I kept highlighted from the Strat are your inside bars and your outside bars. And the reason for this is usually when these bars present themselves, we're gonna have a pretty big imminent move, right? And when they present themselves off of a level, it's even better. So that's one of the things I kept, and that goes to the first indicator. So the first indicator I'm using is the Strat Assistant. Basically I turned everything off and I only have the 1 bar highlighted and the 3 bar. And I also got the full time frame continuity thing going just so I can see what's going on in terms of all the time frames. Usually when I'm day trading, I'm looking at 3 time frames anyway. I'm using the 5, the 15, and the 30, but it's good to have it kind of on the screen right here. Yeah, so once we draw our levels from the previous day, I go and draw my fibs, and the way I draw fibs are I draw them from pre-market high to pre-market low, and we want to be prepared for both scenarios, bullish and bearish, so I draw them both ways, right, for retracements and extensions. And I'll explain the significance of the fib levels I use. So as you can see, I use the 50, the 61, the 70, and the 78. I use these based on ICT methodology. It's a dude on YouTube that teaches like price delivery and stuff for Forex, but I've seen that for the most part, these fib levels work remarkably well with stocks. So the 0.50 fib is going to be fair value. What does that mean? It means that the security is priced fairly. If the trend is bullish, if it retraces back to the 50, bulls are going to start buying it up because it's priced fairly, right? Nobody wants to buy something that's overpriced. They're going to step in when it's fairly priced. And the same thing when it's bearish, we'll get something that goes to the fair value. It's fairly priced, but if the trend is bearish, people won't be so reluctant to step in. So that's fair value. It's a significant level. The other levels, the 61, 70, and 78, are going to be considered either discounted levels or overpriced levels, right? So, for example, let's say the trend is bearish, right? And we're hovering at these levels. These are now considered overpriced. This is your first overpriced level, second and third. Usually anything that's hovering over the 0.78 is not going to stay there very long if it's against the trend. And the same goes for under, right? So first discount, second discount, third discount. Below this, we're usually going to get some nasty movement up. Excuse me. So that's what I'm doing pre-market. I'm drawing my fibs, and I'm making sure I'm monitoring these levels. And if you look, right, some of these levels coincide with yesterday as well, right? Fair value is going to be considered 394.33. And you can see that on the previous day, we wicked out of that level a whole bunch of times. We're bull stepping in until the trend was broken, right? So that's the other reason I don't want to draw a whole bunch of lines on the chart, because it's just going to clutter it up, right? So I draw my fibs before the market opens. I monitor that, see where price action is. The next thing I have here, this is just a script that we wrote. But basically what it is, it's the 5 and 12 EMAs. I use these to read trends, right? So usually on a strong trend, the price action is either going to ride the EMAs or reject it consistently, right? So here we went on a short-term bearish trend, right? Price breaks the 5 and 12, tries to get above, rejects it, and keeps bleeding off until it does take it back, right? So I use the 5 and 12 EMAs to kind of read the trend, see what it's doing. My blue line here is going to be my 200 moving average, and this is my 50 moving average. These are significant levels because usually price is going to have a strong reaction at these levels, especially if they cross like this, right? So here the SPY tries to get above, they crossed over, strong rejection, and breaks the pre-market low from before. Anyway, so that's my other indicators I'm using. I use the EMAs. I used to solely use them to gain entries, but not anymore. Now I'm just using them to read trends and kind of help me stay in the trade longer. So that's going to be indicator number 2. Obviously, we got volume, right? So you want to see volume, I'll keep that on. And then the other indicator I have is this. This is a relatively new one I've been using. Is the Bajogum key levels, whatever that dude's name is. Basically, what this is based on supply and demand, and it'll draw some zones for you of where price has been rejecting or having strong reactions. For me, I like it because it automatically draws these zones throughout the day, right? So I don't have to manually do it. So I've been messing with this indicator now recently, and it's been proven very well. So that's basically it. I'll load it up for you, and then sometimes I'll look at pivot high and lows. I usually do that on the 15 and the 30, and I'll mark those levels off as well on my other charts. But just for video and time's sake, I'll keep it simple, right? So now that we covered all these indicators, we'll kind of show what happened with price action. So this was on Thursday.